Namaste. In this video, we will discuss about Ind AS 8, that is accounting policy, changes in accounting estimates and errors. Objective of this Ind AS is to prescribe the selection criteria for accounting policies and changes thereof and changes in accounting estimates and correction of errors along with the disclosure requirements. So, intents of this NDS is to enhance the relevance and reliability of financial statements that we are presented to the users of the financial statements at mass level and comparability of financial statements among different entities. The scope of NDS 8 is in selection and applying accounting policies, accounting for changes in accounting policies, and changes in accounting estimates and correction of prior period errors. So it address three elements. First, the selection and application of accounting policies and accounting for change in accounting policies and changes in accounting estimates and correction of prior period errors. So let's take one example related to it. Whether change in functional currency of an entity represent a change in accounting policy. So we look at the scope that it is applying regarding the accounting policies, changes in accounting policies and changes in estimate and correction of prior period error. So change in the functional currency does not fall in any of the scope of Ind AS 8. Neither it is accounting policy, nor it is a change in accounting policy, nor it is estimate, and nor it is a correction of accounting policy. So it is out of the scope of Ind AS 8. So it is mentioned that a change in functional currency of an entity does not represent a change in accounting policy, and therefore Ind AS 8 does not apply over this change. Next is what is accounting policies? Accounting policies are principles, convention, bases, rules, and practices. Those are used in preparation and presentation of financial statements. So if we check one example, there is a change in inventory cost formula. Whether a change in inventory cost formula is a change in accounting policy or change in accounting estimate. So if we check, accounting policy represents the principles, convention, bases, rules, and practices. So changing the accounting cost formula will be part of disclosure of accounting policies. So it will be considered as a change in accounting policy. So, and when next is how to select an accounting policy. So we need to check whether any accounting NDS exists regarding that accounting, the nature of transactions for which we are going to form accounting policy. So if NDS exists, in that case we need to apply formula by determining by applying that NDS. And if there is a no formula, in that case, we need to judge for creating a policy judgment criteria we need to follow. We need to check whether there is any other NDAs dealing with the similar or related matter, or whether there is something related in the conceptual framework to the accounting standards, or whether there is a pronouncement of IASB or any other accounting bodies, or if there is a something mentioned in the conceptual framework of related IASB or any other accounting bodies framework, or is what is the industry practice in that regard. So in case we are going to formulate accounting policy, we need to first check whether any NDS exists. If yes, then we need to form a policy based on the that NDS. And if there is a no NDS exists, in that case we need to apply judgment and we need to check the similar transaction treatment in any other NDS or framework, or if does not there in NDS and framework in NDS, in that case we need to look after the IASB or other accounting bodies. And we are not supposed to apply all NDS if amount is immaterial. And the policy that we have formulated, we need to apply it consistently year to year. We are not supposed to change the accounting policies. And there are some criteria where we can change the accounting policies that we will look in the next slides. So if we look after about the accounting policies, changes in accounting policies, it will be changed if it is required by the IND or it will result in reliable and more relevant informations. Only in these two cases we can change the accounting policies if the change is required by the NDS or it will result in reliable and more relevant informations. So let's take some examples about it. Can an entity voluntarily change one or more its accounting policies? So again the criteria is given that it should result in reliable and more relevant information to the users of the financial statement. Only in that case entity can voluntarily change the accounting policy. Next is whether a entity can change its accounting policy of subsequent measurement of PPE for revaluation model to cost model. So again, if it is going to result in more providing more reliable and relevant information, it can change the accounting policy and it will be accounted for retrospectively in accordance with Ind AS 8. So changes in accounting policies, there are two conditions. Either it is required by Ind AS or it is going to result in reliable and more relevant information. Apart from it, transaction that differs substantially from the earlier transaction. It means the nature of transaction is different for which the accounting policy is drafted. In that case, it will not be considered a change in accounting policy. Similarly, new policy for new or previously immaterial transactions. Earlier, some immaterial transactions were there, but there was no policy to deal with those accounting standards. But now the volume is material and new policy is formed. In that case, it will not be considered as a change in accounting policy. Let's take some example about it. Entity ABC acquired a building for its administrative purpose. So this building was for administrative purpose and presented the same as a PPE in financial year. This during the next financial year, it relocate the office to a new building and lease the said building to a third party. So the building that was used for administrative purpose now has been leased out. Following the change in the usage of the building, entity ABC reclassify it from PPE to investment property in financial year. This should entity ABC account for the changes as a change in accounting policy. So if we look at this transaction, earlier this building was used for administrative purpose, but now it has been leased out. So the nature of the transaction has been changed. Transaction that differ substantially from the earlier transaction. Earlier it was used for the business, but now it has been rented out for as an investment property. So in this case, this is a change in classification of building from proper PPE to investment property due to change in the purpose for which it was held and will not be considered as a change in accounting policy as we have discussed in this line here. And initial application of policy of revalue asset to be dealt with in days 16 and 38 and will not be considered a change in policy. Apart from it, if we summarize, if there is a NDS has transitional provision, when there is a change in policy, we need to check if there is a transitional provision, we need to follow it. If there is a no provision of his or if there is a voluntary change, we need to apply the changes retrospectively. And if accounting Ind AS has been announced and but it is not applicable right now and company has chosen to early adopt it, so it is not called a voluntary change and that is we need to use the transitional provision. And if no NDS is available and we are using IASB pronouncement or similar bodies, so and there is some changes in the IASB pronouncement, and because of that we need to change the policy, it will be considered as a voluntary policy change. So let's take one example on it. An entity developed one of its accounting policies by considering the pronouncement of an overseas national standard setting body in accordance with Ind AS. Would it be permissible for the entity to change the said policy to reflect a subsequent amendment in that pronouncement? So, as we have discussed, that if there is a no Ind AS and the entity has used IASB pronouncement or any similar body's pronouncement and there is a change later, so it will be considered as a voluntary policy change. And in case of voluntary policy change, we need to change. It is allowed only when it results in reliable and more relevant information, and there is no contradiction with other provisions of Ind AS 8. So let's check. As such a change is voluntary change in accounting policy, it can be made only if it results in information that is reliable and more relevant and does not conflict with the sources in Ind AS 8. So next is the comparatives. What is the difference between the retrospective application and prospective application? So if we check when the retrospective and prospective is applied, in case of retrospective, it is a default method. If India require a voluntary change is there with the transition provision, we need to apply the retrospective application. And prospective application is only when retrospective is impracticable. And for the adjustment, we need to adjust the opening balance of the equity in the earliest prior period. And here we need to apply from the earliest practicable date. In case of comparative, we need to restate it as if new policy always apply. And in case of prospective application, no restatement is of prior periods is required. And in case of retrospective applications, we need to adjust normally retained earning or any other equity component if required. And in prospective applications, only it affects the profit after the changes. And here the objective is to ensure full comparability over the time. Figures of the current year that we have presented should be comparable with the comparable period that we have presented. So purpose is that. And case of prospective application, it allows changes when the full retrospective is impossible. So next is about the disclosures, mandatory transitional changes where Ind AS applies. So it we need to disclose the Ind AS title, nature of the change and transitional provision, amount of adjustment, line items, EPS. If impracticable to change, we need to explain the reason why and from when it will apply. And if there is a change of policy, voluntary change, in that case, we need to disclose the nature of changes in the policy and region, adjustment amount, each financial statement, line item wise, and EPS. If impracticable, again, we need to explain why and from when it will be applied. And in case of new Ind AS that has not yet been effective, we need to, for the cases where Ind AS has been announced but it has not yet made effective, we need to disclose the fact that this Ind AS has not been applied while preparing the financial statements of the entity. We need to disclose the title, nature, and effective date of it, and the planned date for the adoption when entities is planning to adopt it, and what will be the expected impact on the current year financial statement. And if it is not estimable, in that case, we need to disclose the reason of it. Next is the accounting estimate. Estimates are required when the item involve the measurement uncertainty. So there are a lot of items where we need to measure the financial impact on the entity. And here we need to use the assumptions and use the latest reliable information. For example, when we are estimating the loss allowance on the financial statement, financial assets or liabilities, we are measuring the fair value of the assets and liabilities, and we are calculating the net realizable value of the inventory. We need to judge how much the impact will be there on the on the inventory of the market conditions. When we are calculating the appreciation, we need to estimate the useful life of the asset, and apart from it, we need to judge the warranty provisions also based on the historical events, historical expenditures that an entity has occurred to provide the warranty on its product. So when there is a change in the estimate, it may be because of the circumstances have changed, or new information has evolved, or there is some development, or on the based on the experience. So, if there is a change in estimate due to the new information or development, it is not called correction of the error. It is called change in accounting estimate. And if there is a change measurement basis is a change in accounting policy. It is not called accounting estimate. For example, if we are changing from cost module to any other module, in that case it will be not called as a accounting estimate. And if it is difficult to distinguish between the change in policy and from the accounting estimate, then it will be treated as a change in accounting estimate. And where there is a change in the accounting estimate, we need to apply it prospectively. There is no option to apply it retrospectively, because these are the estimates, not the accounting policies. And when we are applying changes prospectively, if we need to apply it in current year, if it affects the current year only, for example, estimation of bad debts, and if it affects the current period as well as future period also, in that case we need to apply similarly. For example, depreciation, if there is a change in the life of the asset, it will affect current year also and upcoming years also. And we need to disclose the nature and amount of the change in the estimate affecting current and future periods. And if future period affect impracticable to estimate, then we need to disclose about it. So next is about the errors. So errors are wrong recognition, measurement, presentation, and disclosure. So error may be in form of recognition also. It may be in form of measurement as well as presentation and disclosures. And we need to fix the current period errors if it has been identified before issuing the financial statements. And if there is a material prior period error, we need to correct it retrospectively by restating the comparatives or by adjusting the opening balances earlier period. And if it is impracticable, then we need to correct prospectively from the earliest practicable date. And we need to disclose the nature of the error, amount, line item wise, and EPS if applicable. And we need to provide the opening balance sheet also. And if it is impracticable, then we need to explain the circumstances, and there is no need to repeat the disclosures in future financial statement about the errors. So the hookup line is, if there is error, we need to restate it if possible, and if it is not possible, then we need to fix it prospectively and disclose the reason of it. So let's take one example. An entity has presented certain material liabilities as non-current in financial statement for period X1. While preparing the annual financial statement for X2, it discovered that these liabilities should have been classified as a current. We classified these liabilities as non-current, but we now identified that it should be current. So this management intend to restate the comparative amount for prior period X1. Would this reclassification of liabilities from non-current to current in the comparative amounts to be considered to be correction of an error under Ind AS 8? Would the entity need to present a third balance sheet? So as we have discussed that error can arise in respect of the disclosure also. So we need the correction. So considered as a correction of error under Ind AS 8. The reclassification of liabilities from non-current to current would be considered as a correction of error. And Ind AS 1 require an entity to present a third balance sheet also at the beginning of the preceding years. So So we need to check what is the difference between the errors and estimates. So here the nature is there is a mistake in recognition, measurement, and presentation and disclosure. So example maybe wrong policy that we have applied if there is a miscalculation, oversight, or fraud. In case of estimate, there is a approximation needs revision when new information has arisen or new experience has come. So it may be examples maybe if there is a incorrect useful life estimation or provision for doubtful debts if there is a change in the amount estimated and correct. So for the treatment of errors we need to correct it retrospectively, but in case of estimate we need to apply it prospectively, either current or future period. And we need to disclose the nature, amount, opening adjustment, and if there, it is impracticable then the reason of it. And in case of estimate we need to present the nature and amount of the change, and if future effect impracticable then we need to disclose the fact of it. And in effect of PL not included in discovery years PL, and it is adjusted in prior periods, and here it is included in current as well as the future period. And hookup line is to remember the difference is that if there is an error we need to restate the past, and if it is an estimate we need to change the future. So to easily remember, for errors we need to look back, and for estimate we need to look forward. Apart from it, regarding the impracticability in respect of the retrospective application and retrospective reinstatement, it is called impracticable when it we cannot adjust prior comparative and data is missing and we cannot recreate it. And estimates harder for the past because of the long time gap, maybe for 20 years and 30 years, and data is not available. And but we need to use the information available at that past reporting date, but we need not to change, we are not supposed to hindsight something. We need to use the same assumptions those were available at that time when the decision was taking for the making the estimate. And if estimate needs information that cannot be separated past versus later, then retrospective is not possible. Again, no hindsight rule we need to follow. We are not supposed to use later events and knowledge to adjust the past event. So this is all about the Ind AS 8 accounting policy, changes in accounting estimates and errors. We have discussed it along with the practical applications. If you have any questions, you need any clarification, you may discuss on the WhatsApp number or you may comment on the video about your queries. I will reply you back. Thank you. Namaste.